session, we will be taking up a problem from the exam kit, the Hare Events. Now, Hare Events is a company which organizes sporting events. In the particular question, they organizes two events. One is the full marathon and the second one is half marathon. This is a question on multi-product break-even analysis. Now, I will give you a quick tip. Whenever you do a problem on marginal costing, it is better to arrange the data from the question in a particular format. This will make you very easy to arrive at the final answer. So let's take a look at the format that you have to prepare before starting off with the answer. So this is the format. Now, in a marginal costing problem, you might have one product or more than one product. So first write the product name, then write the budgeted units. Then comes the selling price per unit. You have to reduce the variable cost per unit, so you get the contribution per unit. And finally, you take note of the total fixed cost. This is the only information that you need for tackling any kind of marginal costing questions. Now let's start off with the question extracts. So as you read the question, we will key in the required data in our format. So this is the format. So you have the full marathon and the half marathon. So these are the two products. Entry fee is $55 for the full marathon and $30 for the half marathon. So the information that we have just read is nothing but the selling price. So against the selling price per unit, please write $55 and $30. Now, the maximum entries expected is 20,000 for the full marathon and 14,000 for the half marathon. The number of entries expected to sell, that is nothing but the budgeted number of units. So against budgeted number of units, please write 20,000 under full marathon and 14,000 under half marathon. Now coming to the cost part. Runners will receive a race pack, which includes a medal and a t-shirt. Water stations are needed at every 5 kilometer point. These are variable cost. What are the two types of variable cost? One is the race pack that is being distributed, and the second one is the cost of the water stations that have to be set up. Now, Hare Events will also incur fixed costs like council fees, etc. So the cost details are. So you have the race packs and the water stations for the full marathon and the half marathon. So this is nothing but the variable cost. Next, they have given details about the fixed cost like council fees. So this part is nothing but the fixed cost. So first, let's key in the variable cost per unit. The total of 15.8 and 2.4 comes to 18.2. And for the half marathon, the total of the variable cost comes to $12. So let's key it in the format. So variable cost per unit is 18.2 and 12. Next, we key in the fixed cost. So the total of the four types of fixed cost gives an amount of $385,000. So we key in the total fixed cost as $385,000 in our format. Now, all that we have to find is the contribution per unit. And what is contribution? Contribution is selling price per unit minus variable cost per unit. So it comes to 36.8 for full marathon and $18 for half marathon. Now, what they have asked in the first subpart is, if Hare Events decides to host only full marathon, which means that half marathon is not there. So let's strike it out. Find the margin of safety in percentage. So how do we find out the margin of safety in percentage? The formulas that are required are, first we have to find out the break-even point in units, which is given by fixed cost divided by contribution per unit. Next, we have to calculate the margin of safety in units, which is budgeted sales in units minus the break-even point in units. Next, we have to calculate the MOS, or the margin of safety, as a percentage, which is given by MOS in units divided by budgeted sales in units. So let's first tackle the first formula, the break-even point in units. Fixed cost. Fixed cost is $385,000 and contribution per unit is 36.8. Substituting those figures in the formula, we get 385,000 divided by 36.8, or 10,462 units. Now, MOS is budgeted sales in units, which is 20,000 units. minus break-even point in units is 10,462. So the answer of MOS is 20,000 minus 10,462, which gives an amount of 9,538 units. Now coming to the last formula, that is MOS as a percentage. It is MOS in units, which is 9,538 units, divided by budgeted sales in units, which is 20,000 units. So we get 9,538 divided by 20,000 or 0.477. So expressing as a percentage, we have to multiply it with 100. So it is 47.7%. So we are done with the first part of the question. Moving to the second part, if freeze entries are sold in a constant sales mix. Now, what do you mean by a constant sales mix? There is a ratio that is existing between the full marathon and the half marathon, and it is based on the expected race entry numbers. What is the expected race entry numbers? It is nothing but the budgeted units, that is 20,000 and 40,000. So what is a constant sales ratio? It is 20:14. Find the sales revenue needed to achieve the break-even point in dollar thousands. So what are the formulas that we need? Break-even point in dollar for the constant sales mix is fixed cost divided by weighted average C/S ratio. And what was the formula for weighted average C/S ratio? It's nothing but total contribution divided by total sales. So we will first arrive at the weighted average C/S ratio. So what is the total contribution? We've got two products and the contribution per unit of full marathon is 36.8. To get the total contribution, multiply it with the number of units. So it is 36.8 multiplied by 20,000. That's the contribution for the full marathon. And for the half marathon is $18 per unit multiplied by 14,000 units. So that comes in the numerator. It is 20,000 units multiplied by 36.8 plus 14,000 units multiplied by 18. Now coming to the denominator part, that is the total sales. The budgeted units is 20,000 for full marathon and the selling price is 55. So the total sales is 20,000 into 55 for full marathon, and for half marathon, it is 14,000 units multiplied by selling price of $30 per unit. So we substitute those figures in the denominator to get the weighted average C/S ratio as 0.65. Now coming to formula 1, that's the break-even point in dollar. It is fixed cost, which is $385,000, divided by weighted average C/S ratio is 0.65. So substituting those figures, it's 385,000 divided by 0.65 or $592,308. So we are done with part 2. Coming to part 3, Hare Events requires a profit of $500,000. Find the number of entries Hare Events will have to sell for each race to achieve this profit, assuming constant sales mix. So here we are supposed to find out the number of entries or the number of units. So the first formula is sales required for achieving a target profit in dollar. If it's a constant sales mix, it's given by the formula fixed cost plus required profit divided by weighted average C/S ratio. So fixed cost is $385,000, required profit is $500,000, and the weighted average C/S ratio we calculated in part 2, it was 0.65. So substituting those figures in the formula, we get 385,000 plus 500,000 divided by 0.65. So the answer comes to $1,361,538. We don't want the sales in dollar. We want the sales in units because it is mentioned number of entries. Number of entries means sales in units which is required. So basically we will have to split the total sales between the full marathon and the half marathon. And how do you split the sales in dollar between the two products? It is always based on the sales value ratio or the sales in dollar ratio. Never split it in the ratio of 20:14. Why? Because 20:14 is not the sales value ratio. It is the sales units ratio. So we need the sales value ratio. So how do you find out the sales value for full marathon and the half marathon? Fairly simple. Just multiply the units with the selling price. You get the sales in value.
So the sales and value of full marathon is 20,000 units multiplied by 55. And for half marathon, it is 14,000 units multiplied by 30. So the sales value ratio is 20,000 multiplied by 55 for the full marathon and 14,000 units multiplied by 30 for the half marathon. So solving and simplifying it to the lowest form, we get the ratio as 110:42. So our next task is to divide the sales value of 1,361,538 in the ratio of 110:42. So how do you divide it? So for full marathon, it is 1,361,538 divided by 152. What is 152? That's the total of 110 plus 42 into 110. What is 110? The share of full marathon. So it comes to 985,323. And for half marathon, it is 1,361,538 divided by 152. That's nothing but the total of 110 and 42 multiplied by 42. That is the share of the half marathon. So we get $376,215 for the half marathon sales. So this is the sales in dollar. We don't want the sales in dollar. We want the sales in units. So what should you do? You should divide it by the selling price. So the selling price is 55 for the full marathon and 30 for the half marathon. So dividing it by the selling price, the sales in units or the sales in entries, it is 985,323 divided by 55 per unit, which is 17,915 entries. And for half marathon, it is 376,215 divided by selling price of 30, which gives the number of units as 12,540. So we are done with part 3 of the question. This is the fourth subpart. Hare Events is also considering including a 10-kilometer race. So this is a new racing event. It expects the race will have an entry fee of $20 per competitor. That's nothing but the selling price. So let's key it in the format that I have already taught you. So the selling price is $20. So I'm keying it against the selling price and variable cost of $8 per competitor. So we write against the variable cost $8. So we can find out the contribution. It is nothing but 20 minus 8. So it is $12 per unit. Now coming back to the question, fixed cost associated with this raise will be $48,000 in total. So we write the fixed cost as $48,000. So our format is complete. If the selling price per competitor, the variable cost per competitor, and the total fixed cost for this raise all increase by 10%. So what will happen? So first, let's find out what is the figure if there is a 10% increase in these three items. So we have to multiply by 110%. Why 110%? Because it is mentioned in the question that there is a 10% increase. So selling price, if it increases by 10%, it's 20 into 110%, which gives an amount of $22. Now variable cost, it is $8 multiplied by 110%, which gives an amount of $8.8. And total fixed cost, if it increases by 10%, it's 48,000 into 110%, which gives an amount of 52,800. And the revised contribution will be selling price minus variable cost, which gives an amount of $13.2. Now let's get back to the question and see what was asked in the question. So they had asked if the selling price per competitor, the variable cost per competitor, and total fixed costs for this race all increase by 10%, what will happen to the break-even volume and the break-even revenue? Place a tick in the boxes in the table below as appropriate. So they are asking you what will happen to the break-even point in units and in value. So we have to tick whether it will change or whether it will not change. So let's get back to the figures. So these are the figures that we had arrived. So these are the original figures and these are the revised figures after the 10% increase. So first we will calculate the break-even point in units for both the situations. So break-even point in units is given by the formula fixed cost divided by contribution per unit. So what is fixed cost in the first case? It is $48,000 divided by 12 per unit. So we get an amount of 4,000 units. And in the revised situation, that is when there is a 10% increase, the fixed cost is 52,800 divided by contribution of 13.2. So we get 4,000 units. So there is no change in the break-even point in units. So in the table, where should we tick? We should tick it will not change. Now coming to the break-even point in dollar. So since we have already found out the break-even point in units, it's very easy to find out the break-even point in dollar. You have to just multiply it with the selling price. So in the first case, it's 4,000 units multiplied by selling price of 20. We get a break-even point in dollar of $80,000. And in the second case, it's 4,000 units multiplied by a selling price of $22. So we get an amount of $88,000. So it means that the break-even point in dollar will change. So in the table, we have to tick under it will change. Now coming to the last subpart, which of the statements relating to cost, volume, profit analysis are true? Production and sales levels are assumed to be same so that there is no inventory movement. That is correct. Second one, the contribution to sales ratio or the CVP's ratio can be used to indicate the relative profitability of different products. That's also true. We evaluate the profitability of each product by finding out the CVP's ratio of each product. Coming to the third statement, CVP analysis, that's the cost, volume, profit analysis, assumes that the fixed cost will change if output either falls or increases significantly. This is wrong. The primary assumption is fixed cost will remain fixed. It will not change as long as it's the relevant range. So within the relevant range, it is assumed that fixed cost will be constant. So statement 3 is wrong. Now coming to statement 4. Sales prices are recognized to vary at different levels of activity, especially if higher volume of sales is needed. No, it is always assumed that selling price is constant, which means that statement 1 and statement 2 are right, and statement 3 and statement 4 are false. So the correct option is option C, that is 1 and 2 only. So we are finally done with the question. If you have found this video useful, do click the subscribe and the like button and do share it with your friends whom you feel will benefit from the video. So thank you all and meet you in the next video.